Bismillahirrahmanirrahim. Excellencies, distinguished guests, ladies and gentlemen, it gives me great pleasure to welcome you to an exciting panel discussion titled Implications of the African Continental Free Trade Area for the demand for transport infrastructures and services. Wow, this is a mouthful, but rightfully so, given the fact that Africa has so much to offer. A lot more in terms of offering to the global community, but also to Africa itself. Today's panel is brought to you by UNECA, the United Nations Economic Commission for Africa. And as you're aware, Africa is the next frontier. Global trade is one that impacts each one of us. But no other continent can say today that they're at the forefront of an economic revolution. Today, we'll discuss matters related to the African Continental Free Trade Area, an agreement that came into effect in 2019, aimed at bringing together 55 countries, more than 1.3 billion people, and approximately more than $3.4 trillion in trade. The unique aspect of the free trade area is that it has the potential to uplift more than 30 million people out of abject, extreme poverty. But achieving its full potential will depend on putting in place significant policy reforms, trade facilitation measures, and investments. It will boost Africa's income by $450 billion by 2035 and add $76 billion to the income of the global community. It will increase Africa's exports by $560 billion as well. Now, the implementation of the AFCFTA began in 2021, but the current transportation infrastructure and the services that it's providing are rather poor, and this is perhaps the impeding factor that is hindering Africa's growth. The United Nations Economic Commission for Africa has conducted research on the impact of the AFCFTA on the demand for transportation. And I will highlight a few key numbers from this research. Over 25% of intra-African trade gains in services would go to transportation, and over 40% of the rise in Africa's services output would be a result of the AFCFTA. Essentially, the implementation of the AFCFTA will lead to an increase in approximately 28% of trade within the continent without the implementation. Africa will need more than 100,000 rail wagons and will need more than 2 million trucks. Yes, more than 2 million trucks at full capacity. And aircraft demand will increase approximately 12 to 15% between North, South, East, and West Africa. Now, these findings suggest the need for huge investments, not only in roads, railways, seaports, and air infrastructure, but indicate that we need to invest in our own governance structures, the political will, and attract the appropriate investment not only within Africa, but outside Africa. Now, before I go further, let me introduce you to our esteemed presenters and panelists. We have, from the United Nations Economic Commission for Africa, Dr. Stephen Karingi, who is currently the Director for Regional Integration and Trade of the ECA. We have Mr. Robert Lisinge, the Trade and Transport Facilitation Specialist and a leading road safety expert in Africa. And both of them will deliberate on today's theme and some of the points that I've highlighted. Following their presentation, we shall have a panel discussion with Mr. Isaac Mahlangu, Chief Executive Officer of the Mpumalanga Economic Growth Agency, a regional investment promotions agency in South Africa, Engineer Ahmed Mansour, the Group Executive Director for the Dangote Group from Nigeria, and Ms. Eva Warigia, the Executive Director and CEO of the East Africa Venture Capital Association. I give the floor to you, Mr. Karingi and Mr. Lisinge, who will speak on the findings of the AFCFTA Transport Report.
Thank you very much, Ali. Good morning to everyone. I don't know whether we are being streamed, right? You can put on the presentation. So we've been coming here at the AIM for a couple of years. And when we first came here, we started talking about the AFCFTA. Now we have the AFCFTA. You have heard the numbers of what the AFCFTA can do. But what do we need to do to optimize on the AFCFTA? So what I'm going to do is I'm going to talk briefly about the AFCFTA. I don't want to talk a lot about that. You have heard a lot about that story. We will focus on the requirement for infrastructure because we are here talking to investors and we want to talk about opportunities. And then I'm going to sort of give the numbers and how we arrived at these numbers. Now, so in brief, you have heard what Ali has said. We have looked at if you implement what has been agreed under the AFCFTA, there's going to be a lot of growth in intra-African trade in the area of agri-food, in the area of services, in the area of industry, than if you did not implement the AFCFTA. And if we zero in the area of services, a lot of that is actually going to happen, a lot of growth is going to happen in the area of transport and in the area of aviation. What I would want you to take away from here is to know that today, Africa trades within itself at about 18% of its total trade. And also, for the trade that happens between Africa and the rest of the world, most of that trade, as you know, is not value added. Most of it is raw materials. Now, according to these numbers, what the AFCFTA is going to do is actually to grow not only the intra-African trade from the 18% that we have today, but also most of that trade is going to be on value added. So how do you unlock that? So what we did, we decided to sort of unlock, to focus on the area of transport, because I need to say that in addition to opening up the trade in goods, the AFCFTA is also opening up the trade in services. So there's going to be liberalization in transport, there's going to be liberalization in financial services, there's going to be liberalization in communication, there's going to be liberalization in tourism, and even our business professionals are also going to be able to travel from one country to another. So here we are focusing on the opening up of the transport services. So what do we need to, what are the opportunities that the transport sector provides? And so this is the question that we wanted to answer by first of all asking, what is the demand in terms of transport services if you implement the AFCFTA? And then, of course, we have quantified that. Okay, so there are four scenarios that we looked at, so we are not going to go into depth in terms of the techniques of the methodology, but just to say, if you look at the x-axis and the y-axis, you actually have the free trade area, whatever you do under the implementation under the AFCFTA, and then what you do under the infrastructure. So the first scenario, we said, you have a maximum ambition of implementing the AFCFTA, but you do nothing in terms of infrastructure. And then in the second scenario, we said you have a maximum ambition. Every state party of the AFCFTA implements on its commitments, and then you also invest a lot in infrastructure because, as you know, Africa has what we call the Program for Infrastructure Development in Africa. And then you have a third scenario whereby you basically have a baseline without the AFCFTA, and then you do nothing. And a scenario 4 where you do a baseline without the FTA, and then you do everything on the AFCFTA. So obviously, where we want to be is where we implement the AFCFTA, and also we build our infrastructure. That is scenario 2. Now, so at this point, I want to say there is what we call the critical links within the current network. It's what you see on the left panel. And on the right panel, you have the critical links with current network plus planned projects. Now, from an engineering point of view, a critical link is a link that if nothing is done there, then there will not be movement in terms of logistics or in terms of facilitation of movement across borders. So you can see on the first map where most of those critical links are, and then on the right side, you see a map with all the added opportunities that are going to be added if we were to implement what we have in the program, in the program for infrastructure development in Africa. Obviously, at this point, these are investment opportunities for government and also for public-private partnership. So after looking at the trade that I said would happen if you implement the AFCFTA, what then do you need in terms of, and assuming that you have built the infrastructure, what then do you need in terms of the equipment to move the volume of goods that are going to move from one country to another? So here is the kind of result that you get from our analysis in terms of what moves through the road. We will need close to 2 million trucks for bulk cargo and about 250,000 trucks for container cargo by 2030. So essentially, this increases to about 2 million and 268 trucks respectively if the planned infrastructure also happens. So there is the trucks that you need, assuming that you do nothing and you implement the AFCFTA, but if you also add on the infrastructure, you can see you even need even more equipment. So those are the kind of numbers you can see. Scenario 2, that is the green, it gives you a higher number in terms of bulk and also in terms of containers. Now, we also looked at where is this demand going to happen. Is it in North Africa, South Africa, West Africa? Because it's important for us to know where do you focus the investment. So according to our analysis, the largest demand for these trucks to support the AFCFTA is going to happen in West Africa with a share of about 39%. And then demand from West to South Africa is 19.8%. And from Southern Africa to Western Africa is about 9.9%. So of course, if you want to optimize on the AFCFTA, you can see where most of the investments are supposed to be within West Africa and also followed from West Africa to Southern Africa. That is in the context of the roads. Maybe you can help me. Okay. Now, then this relates to the railway. You can see there is actually very limited, very low railway connectivity within the continent. At the moment, you have critical links that are shown on the left-hand side, and then you have critical links of what is planned. So the question is, if you were to just use what you have on the left, you probably will not be able to take account of the increased share of trade that is going to happen within the continent. But if you invest at least on what is planned, we will see what would happen. So that is on the railway. So for you to, so we have the four simulations again. What we see is that the AFCFTA would require close to about 100,000 wagons for bulk cargo and about 20,000 wagons for container cargo. And then this would increase significantly to about 132,000 wagons and 36,500 wagons for both bulk and container. Now, as you listen to me, I think what you have also to realize is that the trucks that I'm talking about here and the wagons that I'm talking about here, they have to be produced. And so the question we have to ask ourselves, are you importing these 2 million trucks from outside the continent? Or are you taking advantage of the trade in goods, the manufacturing component that I indicated, to produce these trucks and the components for these trucks within the continent? So we have to think about that opportunity, the opportunity that this offers. We know that there are wagon manufacturers in South Africa. We know there is automotive sector that is very deep in North Africa and also in South Africa and in Eastern Africa. So the question is, the investments to provide for these 2 million trucks, where will that happen? And I think that is something that I want to put at the front of your mind. Maybe you can move for me the next slide, because Okay, so again here we show where most of this largest demand for this rolling stock is going to be. Again, West Africa seems to be the critical area. Maybe it also has to do with some of the high population or the big economy there, Nigeria. Then within Southern Africa, you have that number. And then within North Africa, it's about 11.8%. Okay, and then in terms of, we are in Dubai. We know Dubai ports, it always gets very good numbers in terms of performance index for the Dubai ports. In Africa, we have those critical ports that we see with the current network, and then we have the critical ports that we'll need, that are planned under the Program for Infrastructure Development for Africa. Again, all these, in terms of transshipment across the continent, becomes very critical for the AFCFTA. And so in terms of what the AFCFTA requires, we have indicated number of vessels that you need, both for bulk and for cargo. And what you see here is that in the case of bulk, actually the scenario 1 is quite interesting compared to scenario 2, which we saw to be critical for both the under the road and under the rail network. The largest demand for these vessels is going to happen within North Africa. So here there is a change, and also demand from North to Eastern Africa, and then from North to West Africa. We are happy to share these slides because we know these numbers are very critical for anybody who wants to think about investment opportunities. And I'm trying to go a bit fast so that we can listen to you can move to the next slide. And then, of course, in the area of air transport, we know that Africa, besides the AFCFTA, we also have what we call the single African air transport market. Basically, the open space, the one market for aviation within the continent. You need air transport infrastructure for the AFCFTA to be optimized. Of course, if you combine that with the single African air transport market, you would be able, of course, to increase the share of the African airlines, or at least African air cargo players, because today, most of the market share, as you know, it's basically the non-African aviation operators who are taking control of that. But we believe that the AFCFTA is giving a business case for the air cargo transport, and especially if you also invest in the critical airports that are in the current network and those that are planned. So in terms of aircraft, we will need about 150 additional aircraft by 2030, just for cargo movement within the continent because of the AFCFTA. And again, these are opportunities. Besides the manufacturing, we also have to think about the spares, the components, and I have not spoken a lot about the number of people who will be operating this equipment. So the largest demand for aircraft to support the AFCFTA is going to be within West Africa, and then demand from North to West Africa is about those percentages. So let me come quickly to, you can move the next slide. Me come quickly to the summary. So as you can see, there's going to be a huge increase in terms of what is currently carried today by road. But the most interesting thing is that in the case of railway, there's going to be a shift from the road, a bit of shift from the road, which currently controls 76.7%, and then there's going to be a slight decline to about 70% under the road, but most of that is actually going to increase because of the rail transport. So again, there are opportunities. There is something that has to do with the shift from the road to the rail. We know in terms of climate change conversations, the railway is good, so if you have to put this green element, I think it's not a bad thing, the kind of shift shares we see from this. So overall, with the AFCFTA and without the AFCFTA, we see that the AFCFTA would increase the freight demand by 28%, and the demand for maritime freight will increase the most, but I think this is because of the base effect. we do not have a lot of maritime transport happening within the continent. And this would increase, of course, I've shown in terms of the number of equipment, in terms of trucks. You would have 41% increase, 64% increase in terms of container with the AFCFTA versus without the AFCFTA. And these are huge investment opportunities for anybody who has been asking what is the benefit of the AFCFTA. So besides increasing the intra-African trade, there is huge opportunity for job creation. And I think this is just to summarize the figures that I have given. So anyone here from the continent who is working on this in these sectors and you are thinking, oh, should I have more investment in this? You can see in terms of trucks, you will need to produce more. In terms of railway, governments should also think of, as they do these railway tracks, there is all these needs for these railway wagons. We have put numbers to this equipment. So the estimated costs for equipment. So take the case of trucks. It's about $291 billion, as that is by 2030. In terms of railway wagons, you have about $26 billion. In terms of vessels, $4 billion. And in terms of aircrafts for cargo across the continent is about $25 billion. So it's a significant amount of money that Africa will need to make these things happen. And all this, of course, I don't need to tell investors what this means. So it's basically you're looking at a total of about $400 billion or something like that by 2030 in terms of optimizing transport services within the continent. But there is that assumption also that infrastructure development is also happening. And so I'll leave those conclusions there and let Robert add 2 minutes if there is anything that I have missed. Thank you very much.
Thank you so much, Stephen. I just want to make a couple of points. One on the critical link. Stephen mentioned the critical links. These are links that need to be upgraded, otherwise they will not be able to accommodate the increased volume of trade that we are anticipating. And I can say that our research shows that we have more than 61,000 kilometers of critical links. These links are mostly located in Central Africa, where infrastructure is generally very, very poor, and to some extent in Eastern Africa as well. Stephen mentioned about the program for infrastructure development in Africa. This is key because we've seen that if we implement projects in the program for infrastructure development in Africa, we may be able to close 21,000 kilometers out of the 61,000 I mentioned. So this is more than 30% of the missing links, so to speak. And let me say that last year, African heads of states identified 69 priority projects, which we have estimated would cost about $169 billion to close. So this is a huge investment opportunity on the continent. I think we can have individual discussions, but we know which countries on the continent where we need to close the infrastructure gap to meet the needs of the continental free trade area. Let me also touch about road safety a little bit. Stephen mentioned that we need 2 million trucks to accommodate the continental free trade area by 2030. And we know that in African countries, more than 80% of vehicles are used vehicles, often with very, very low standards. And these have safety implications, but also environmental implications. And so we need to think carefully where these additional 2 million trucks are going to come from. That's why we are advocating for very strong regulation of importation of used vehicles into the continent in the absence of manufacturing going on. Stephen also mentioned that this is a huge opportunity for manufacturing. For instance, if you need more than 150,000 rail wagons, between now and 2030. This is a huge, huge opportunity for countries on the continent manufacturing rail wagon. And let me just end by talking about the share of different modes of transport, which Stephen also mentioned. Right now, rail carries just about 0.3% of freight in Africa. And we see that if we implement the Continental Free Trade Area, this will rise to about 8%. This is a huge opportunity to transform Africa's railways. But again, it's an opportunity for companies on the continent that are manufacturing rail wagons. So there's a lot of rich information and data in our study that I don't believe we need. I think we need more than a day to discuss that. So, Chair, let me just end there, and we are available to answer questions. Thank you.
Thank you, Stephen and Robert, for your presentation on that. And I just want to, before I get to the panelists, I just want to end up asking the presenters, you indicated $400 billion in terms of the infrastructures that are needed. And I just want you to think about this, and perhaps you can answer it after, but how is Africa going to attract that? Because, and especially in about 8 years, and I think that is something that, is just a mind-boggling number right now that I'm looking at, all right? And perhaps, we can talk, we can have a discussion with the panelists, but I want you to answer this at the end, okay? My first question is to Isaac Malangu. Isaac, you're the CEO of the Mpumalanga Economic Growth Agency. And as the CEO, you're tasked with this responsibility of attracting foreign investment, but you are positioned in a very unique area. You have Gauteng province to the west, you have Swaziland to the east, and to the south is KwaZulu-Natal, and to the north is Zimbabwe. What is it about your province and your investment promotions agency that you look at in terms of how you can attract investment, but what is it about the AFCFTA that will enable your region to really grow and succeed in a very different sort of perspective when this free trade area actually kicks in?
No, thank you. Am I audible, Ali? Thank you very much for the opportunity and the question. And may I also appreciate the United Nations Economic Commission for inviting us as a MEGA. Maybe briefly we can start by explaining who are we as an organization. We are a developmental agency located in the province of Mpumalanga in South Africa. It is one of the 9 provinces that we have that were established post the 1994 democratic breakthrough. But essentially what we are doing is we are involved in trade and investment promotion, and we're also involved in the developmental funding of our SMMEs in the province and also in the country, by the way. And we're also doing a massive infrastructure development. But I think that in relation to the question you're asking, Ali, look, our province is currently home to about 4.6 million people of South Africa. And in terms of our GDP contribution, we're somewhere 24.6% throughout the country. This largely is around mining, quarrying, trade and investment involved. And with regard to the signing of the AFTA, the AFCFTA, we regard that generally in South Africa, but of course we are the province of South Africa, we regard that as a particular achievement of the Pan-African vision that our founding forefathers have had over the many years or the decades that we have been struggling with the economic and political settlement of our province. So we believe that the signing of the AFCTA has necessarily created a regional integration, and we are looking forward to ascertaining that we are an active player. You know that as a country we have already signed that. But I must indicate that as the mega, we are also involved in quite a number of projects which will increase the transport infrastructure internally and also in the SADC region. We have developed a very massive Nkomazi Special Economic Zone, 7 kilometers to Maputo Libombo border, but we are also creating a petrochemical SCZ somewhere in about 80 kilometers from Johannesburg. It's internal. It also has to do with transport infrastructure. We'll also create a steel SCZ. And of course, we also have a massive project called Mpumalanga International Fresh Produce Market. So all these matters will then make a contribution as to how we integrate the road and the infrastructure projects that we have in our country. Thank you very much.
Thank you. I just want to add to that. You know, you brought a lot of big opportunities, but I think that the engine of growth for most of Africa and most investment promotion regions and agencies are the SMEs. Okay? How do you see AFCFTA adding to the SMEs that are really in your region? Because you see, you can attract the foreign investors, but the engine of growth of every single country are the SMEs. And it's the SMEs that will add value to the entire infrastructure trade that is going to, take place in Africa. All right? If you can, just touch on that, please.
Well, fortunately, in terms of our legislation, the SMMEs are our primary drivers of the economy in the province. And of course, we disperse developmental funding to them, loans. And in the current circumstance, the situation that, well, look, maybe let me take the two theories that we have had in our country. We have had the one economy very rich and the other very poor in the same country, what we have been calling the colonialism of special type. We are focused as a developmental funding institution. We are focused on the second economy, so to call it, those that are unbankable. And as a result of that, what we have started to do in the pipeline of investment, we are about to create a provincial state bank to ascertain that we even capitalize our SMMEs more, because currently we are extensively undercapitalized and we have not been able to give our SMMEs as much funding as possible. However, moving forward, if we are capable of at least dealing with these various SCZs that we have, many of these SMMEs will be able to, including the fresh produce market. In other words, we are creating a large economic participation for the underbanked, undercapitalized, and therefore we believe that once we grow the economy internally, we will then be able, for the SMMEs, will then be able to contribute as to how we link with our neighboring countries, Swaziland, Mozambique, Zimbabwe, etc. So that is how we are currently working, and we hope that in the next we have created something called Vision 2026. We're hoping that in that particular space, we will have, broadened the SMME sector. Thank you very much.
Thank you. Now, Engineer Mansour, you're the Group Executive Director for Dangote. And I don't necessarily need to end up giving an introduction or explaining, who Dangote is or what the Dangote Group is in Africa. But you work in cement to edible oils, and now we even know oil refineries. And the group is vital to the economic well-being of various different countries in Africa. Over the past year and a half to 2 years, there was a pandemic that impacted supply chain routes and impacted transportation. Can you explain a little how the Dangote Group navigated that? But at the same time, where do you see the AFCFTA adding value to some of the operations that you're involved in?
Well, thank you very much. Yes, I believe that the pandemic had a lot of impact on everybody in the world. Every sector, every operator. But I think one of the key benefits of size of a company like Dangote and operating in many sectors is that perhaps it gives you greater resilience. Yes, indeed, virtually all our supply chains were disrupted like everybody else, but we had the advantage of being a fairly large operator in different sectors. And therefore, we were able to find areas where we can transfer some advantages or some costs from one sector to another. Let's talk about transport, for instance. Dangote Group has probably the largest fleet of trucks in Nigeria, probably in West Africa. We have probably some in the region of 10,000 to 12,000 trucks operating within Nigeria, and probably about 2,000 within the rest of the Africa region where we operate. And to that extent, we were able to absorb some of the impact, for instance, on food to cement, where we are able to move goods, to move the facilities, to use transport in the sector that creates the most advantage. Of course, also, one of the ways to try and navigate these impacts was, of course, to identify which of your businesses has some leeway. Now, in Nigeria, for instance, at the time, there's a lot of effort to distribute food, and we're in the food sector, transporting flour and salt and sugar and so on. So to that extent, we moved a lot of our transport fleet into these areas. Whereas in areas like cement, there are some restrictions and so on. Thirdly, I think obviously the fact that we operate in a lot of sectors, we also are able therefore to engage with government and regulators. And so we're able to find areas where we had the least, if you like, impedance to a large extent. But by and large, the impact of the pandemic was global, particularly to the extent that it disrupted, supply chains. It created problems with the movement of labor and workers and so on. And frankly, it is largely the question of size that enabled us to navigate through some of those things. But coming to transport in particular, the key issue to me, particularly as we have said, if you're going to require to increase your transport network, your trucks by 2 million, obviously a huge investment. And to that extent, clearly we must focus on creating an ecosystem, particularly in terms of investment, that enables Africa as a whole to work together. And frankly, this has been my key point for over the past 2 years since the implementation of AFCA. That yes, integration through the AFCFTA has been, to that extent, the possibility of integration has been created by the signing of the AFCFTA. But integration will happen, especially when we're talking about economic integration, will happen only when the operators, the private sector itself, begin to come together to integrate. Unfortunately, this has not been happening in Africa to a great extent. We sometimes look at Africa as one big market, but it's not. It's about 54 or 55 different markets. And those markets have not been used to trading with each other, as has been shown by the presentation, that only about 18% of total African trade is intra-African, which means we have not been trading with each other. But this has to start. Otherwise, we will not be able to take advantage of this large market. We will simply be expanding the market for our traditional trading partners, which basically is Europe and China and the USA. So I think the first thing that we have to do to address the issue of African integration is to begin to create opportunities for African investors, private sector operators, to begin to come together. And this has another advantage in its own, because when we try to attract foreign investors, It's usually government, public sector officers shuttling to and fro to China, to Europe, to the United States, looking for foreign investors. I think the first thing is to strengthen and empower your domestic investors so they will attract counterparts and partnerships and therefore bring the foreign investment without you having to go out and do it yourself. And I believe that perhaps this is something that we need to discuss further because I feel that we have to create an ecosystem and an environment that begins to encourage and facilitate joint investment by existing current investors. And that also will create an opportunity for foreign investors to come into these partnerships and create scale, because scale is very important. I do agree that SMEs are the engine of growth for development, for general development. But to create competitiveness, to create growth as fast as necessary, you need large-scale operations, because that's where you are able to get the efficiencies that you need to become more competitive. That's where you are able to get the cost structures that you need to become more competitive. If, for instance, you are going to assume that the 2 million trucks will be produced by thousands of small-scale operators, you are not going to get there because those trucks will not be competitive. Those transport services will not be competitive. But if you encourage companies that are already in that business and are growing, then, of course, you can create the capacity for them to produce those trucks more efficiently and more competitively. I think we have seen this in Korea, we have seen it in Japan, in areas where champions or specific operators are given support and encouragement to grow very quickly. The importance of that is also those growing large enterprises create opportunities downstream for the small and medium enterprises to feed into. And that's, in my view, how you probably address the issues of integration and the issues of growth, and to a large extent, the issues of investment. Maybe I should stop here and take it.
I mean, look, you give a very good perspective of intra-Africa trade based on the fact that, the governments need to invest themselves in themselves. But having said that, and I think you give a good perspective of what's going on within the continent, Eva, from what Engineer Mansour indicated, you come from a very different perspective because you're the CEO of IVCA, where you represent foreign investors, mainly private capital, private equity, and venture capital from abroad. As the AFCFTA is actually coming into effect, what do you see the role of trade, transportation, logistics in Africa and their involvement? All right, and what do you think that the implementation and the functioning of the AFCFTA will do for them when they look at perhaps manufacturing on the continent?
Great, thank you so much, Ali. I feel like Engineer Mercer addressed much of my points, but I'll just point to a few things. Many of us in the room are here because we are either Africans or interested in investing in Africa, and like you pointed out, it's a big continent of 50-something countries. For us, the first thing that AFCTA does is open market. So I come from a region with rather small countries in terms of population size and geographical space. The ability to have my capital access the West African market, which is one of Nigeria as an example, is one of the largest population, provides comfort for an investor about the scalability of the investments that we're looking at. So, all right? So the first thing that the AFCTA brings to the table for us at least is access to market. Okay? And the ability that if I am investing in an East African portfolio company, it can have the size of market or ability to tap into a Nigerian population. The second one is access to output or raw materials. One of in his presentation, he pointed out that a lot of the goods that Africa exports or trades out is raw materials. much of the investment these days is in value creation or value addition industries, manufacturing, agro-processing, even tech to some extent. So if I am able to access raw materials, and we talked about it earlier, where you have some countries with shortage of fertilizer, some countries are actually producing fertilizer, but on two different ends of the continent. Connecting raw materials to industry is a big play for the AFCTA. And that also creates excitement of upscaling our value addition as a continent. And then thirdly, and at least for now, my final point on this is just the actual opportunities to invest. Like it was mentioned earlier, a lot of the investment done in Africa's infrastructure is by government. And we, private sector, have capital to invest in our own infrastructure. I'll take an example of one that we're doing in Kenya. We actually just had a Lot 3 road. It's about 100 kilometers connected into one of the transnational highways that's actually being funded by pension funds in Kenya. And this is an opportunity that we see that with the opening of the market, we have ability to create opportunities for private capital to deploy into African infrastructure. And that's in ports, in railways, in mechanization of ports actually, in air terminals and so forth. So that's the other one. But perhaps for the immediate, the one thing that we're really looking forward to as investors is just the tariff barriers being flattened, because clearance of cargo across every border point remains to be one of the obstacles of investing intra-African. Okay, so the fact that we can create a common market agreement with signed protocols of standardization of taxes, standardization of cross-border controls is a big leap for us in terms of advancing intra-African trade and promoting access to different markets, at least from an investor perspective.
Thank you, Eva. Barriers to trade, I think that's probably the biggest takeaway that I get from your point. And having said that, Isaac, you representing, the Mpumalanga Economic Growth Agency, do you see this as a major hindrance? Because goods come in from South Africa, through your province all the way to Egypt. But how do you basically overlook this, or how do you actually integrate this issue in some of the projects that you're involved in? And what could you say to other investment promotion agencies to basically adapt, and what should governments do? Because barriers to trade is perhaps the biggest critical factor that is hindering goods moving from one market to another.
No, thanks, Ali. I think even prior to the conception or initiation of the AFCFTA, which I normally call AFTA, Mpumalanga is that province of ours. One of its biggest achievements post-1994 has been the coming into fruition of the Maputo Development Corridor. Now, that Maputo Development Corridor then links the three other provinces of South Africa with Mpumalanga. You have Gauteng, which is a highly industrialized one. Then you have Limpopo, the other side, and to a certain extent, Free State. But it has been our observation that there has been a large cost of the transportation. For instance, if you pass the toll gates and so on, they've been very highly priced, and as a result, they've been, especially our neighbors, Mozambique, because they use that Maputo corridor a lot, including ourselves. So what we seek to be doing is to ascertain that we have some public-private partnerships alongside the Maputo Development Corridor, and we've put into fruition a particular, even a listed, a company that deals with the management of that Maputo Development Corridor. So it is our view that as a province, we have already played a particular significant role in ascertaining that the road infrastructure is well taken care of. But of course, there are other projects that we are coming with. This time, rail not just on the road, because we believe that post-1994 South Africa has invested a lot in its road infrastructure. We are now, as a province, together with Maputo as another city that other side, conceptualizing a large development around the rail infrastructure, so that you will not just have the road, you also require the rail. Of course, Mpumalanga has an international airport. You also have some that other side in Maputo. So, and same with Swaziland. So you also need to play this aerial war as well as you do with the land war. I think that we stand a better chance of the regional integration, especially within SADC. I'm foreseeing a bright future. Maybe I should stand it there.
Well, I mean, you give a good point in terms of the regional infrastructures that are required for trade. Engineer Mansour, I'm sure this is very critical for you, all right? What does Dangote Group look for when you are looking at investing in a specific country, and this aspect of regional integration and regional infrastructures for trade routes, how critical are they for some of the companies that your group sets up?
Yeah, thank you very much. Well, certainly the regional developments, particularly, as you said, the trade corridors, are going to be very critical to the success of the AfCFTA. Obviously, it's going to be difficult to see the early realization of the cross-continental infrastructure. But if we can link the various regional infrastructures, the various trade corridors, then I think we can see much, much faster progress. Our experience so far has, in fact, confirmed this. When you operate in the West African region, then, of course, you have a focus. Our focus, for instance, in cement was in Nigeria. And we can move either by sea or by land corridors, products across the West African region. For us to be able to access the East African region, we had to move and create manufacturing facilities in Ethiopia, in Tanzania, and so on, so that we can take advantage of those regional trade routes. And the same thing in Southern Africa. We have investments in South Africa that takes advantage of the Southern African route. I believe that this is what will probably happen. Then that means that the regional bodies, the RECs, must also be part of this continental trade development arrangement. So far, I believe that the West African region has made tremendous progress, and I think to some extent the East and Southern African regions. But what is critical, as he has said, and I think as Eva has said, is the need to ensure that the regulatory environment is also harmonized. So that, for instance, if you have harmonized regulatory environments in West Africa, it makes it easier to move goods and services across Africa, and the same thing with Africa. These regional bodies can then work to integrate and link up through the major across Pan-African infrastructure developments. But one thing that I think is urgent is that we have to mobilize private sector funding, because public sector funding will not be enough to do that. $400 billion is not going to be sourced only from public sector funding, even including the international development financing agencies. Not only will that sort of fund be difficult to mobilize, but also the viability of the projects, which is going to depend on public sector, particularly international development financing arrangements, will probably continue to remain in question. So by mobilizing private sector on a massive scale and creating opportunities for joint public-private kind of investments in these areas, and ensuring that these facilities and these corridors operate more in the line of private sector services, I think it will generate faster growth. But to do that, we have to mobilize the private sector funding, particularly the African private sector funding itself, which at the moment I think is not being done. I think we need to create ecosystems and environment that will bring African investors together to begin to operate together, to begin to invest together, and create the initial scale that will also bring in foreign private sector investment on the back of indigenous private sector investment. And that will create a more sustainable, I think, investment arrangement than we are seeing at the moment. Thank you.
Again, this leads into the next question for Eva. Engineer Mansour, he indicated that governments need to invest in their own people, in their own sort of, economies. Regional integration needs to end up taking place. But where do you see foreign investors looking at? And how do you see the type of regional integrations, the type of political will impacting foreign investors' decisions to actually come in?
I think now, especially after COVID, there's a lot of political will. Local governments' priorities to spending have been diverted, so to speak, to social sectors, healthcare, education, post-pandemic, especially, so that infrastructure is now open for private sector play. So a few things, and I draw experience from East Africa, which is where I am largely based. Public-private partnerships are a big deal right now, especially post-pandemic, and some of the different aspects of whether it's build, operate, transfer, or build, operate, own, there's room for that, especially now, because like he rightly said, we cannot rely on government funding for infrastructure. So that's one. The second one, as I said, is creating alternative, sophisticated structures of funding. Commercial banks do not necessarily in Africa have the balance sheet to hold public projects by themselves, at least not without syndication. So how can we create alternative structures that bring in private capital, probably blend it with government capital to finance African projects? So that's another exciting play. And we have seen it, especially concessional funding being blended with private capital. I draw an example of a recent partnership between CDC, which is a DFI from the UK, and DP World, which is actually from the UAE, where they decided to create a plan to invest $1.3 billion in African ports. That's a blend of very private capital from DP World and very public CDC government funding dedicated to African projects. So that's another structure of where we can play. And then lastly is direct influence by private capital. So sometimes governments focus on the main arteries, the corridors, north to south, east to west. But the last mile has a lot of opportunity for private sector interplay. So when you ask me, there's a lot that can be done, particularly with the last mile logistics, whether it's in storage, and now we have a lot of demand on the continent for cold chain storage, whether it's in building the actual infrastructure for last mile city connection, last mile home delivery systems, last mile telecommunication infrastructure in terms of putting internet into households. So those are some of the plays that I see happening right now. My bet is a lot more of the co-investment, blended finance structures that will come on board in coming years.
I'm glad that you brought up the point of the DP World, investment, DP World CDC investment in Africa, especially in infrastructure. And Isaac, one thing I want to ask you is, how do you see this playing out in Africa with different types of investment promotion agencies, and this bridge that the UAE is looking at, the UAE Africa bridge? How can agencies like yours really start attracting that into Africa to enable those type of investments in infrastructure? Because that is, again, the critical lifeblood of what will enable the continent to move forward.
Well, Ali, one of the most difficult environment that any state-owned funding agency found itself in the past 2 years have been, of course, the existence of the COVID-19 pandemic. So we've been therefore working on the post-COVID-19 financing, which if you deal with the SMMEs, they were almost wiped out altogether. But then as an agency, although we're a provincial agency, but we were encouraged by our state president's State of his Nation address, because he came up under the circumstances that we find ourselves in. He came up with a particular program called Economic Recovery and Reconstruction, which we then, migrated that to our province to become a provincial economic reconstruction and recovery program. But we remain hopeful as an agency and any other agency that runs the state, especially in our country. We believe that there's a strong presence of sound financial systems in our country and massive infrastructure development, and that we should be able to capitalize on this so that we can promote the intra-trade in Africa or intra-Africa trade. And we're also looking forward to building long-term and welcoming companies from UIA through the Africa-UIA bridge. We believe that besides the difficult circumstances that we find ourselves in, and the heavy undercapitalization and lack of serious financial muscles of the state-owned enterprises, we are in a position to rise. And as I would always say, Africa shall rise again, and Africa be able to work with the other nations. Thank you very much.
Thank you. Okay, now this is a very selected question, Engineer Mansour. DP World went into Africa with CDC. In South Africa, you're attracting investors to add value to the local infrastructure, Isaac. But Dangote is a name that resonates with everyone on the continent because of the work that Mr. Aliko has done, and his name attracts investors from every single corner of the world. Here in the UAE, we have a number of investors at this annual investment summit, at this AIM, at the annual investment meeting. What could you tell them to look for when they're looking at coming to Africa, and what is your vision? Because I believe some of them will actually take that to heart to say that, okay, wow, if Dangote is looking at it like this, then maybe we should look at it like this. So sorry to put you on the spot.
Thank you very much. Yes, I believe that, first of all, let me comment on Eva's suggestion about or focus on blended financing, because I think that's key to building the kind of financial ecosystem that will support massive investment. Blended financing, which brings in the development finance agencies, international as well as domestic, as well as venture capital type of investors, along with public investment as well as direct private investment. I think perhaps one should say that the commercial banks are also growing, particularly with consolidation. They are going to be able to raise the kind of financing that will go into, but it won't on its own. Commercial financing will not be sufficient except when it is in a very innovative way, combined with the public sector as well as institutional investments to create blended financing structures that actually provide the kind of investment arrangement that ensures profitability, particularly for the private sector. And that will mobilize more private sector financing. So, but what should investors into Africa be looking for? Three things. First of all, I think it is important we sometimes focus too much on the challenges. We do not give sufficient attention to the opportunities that lie behind those challenges. And indeed, what we see in Africa today is that in spite of the current challenges in terms of weak infrastructure, in terms of low level of skills, there are tremendous challenges for people who are willing to invest for the long term. And I think this is the first thing that foreign investors coming to Africa should try and focus on. Look at the challenge, look at the opportunities there. There's no continent, in my view today, that has long-term opportunities for investors than you can find in Africa, both in terms of potential profitability, but also in terms of growth potential. Look at our demographics. In terms of demand for every kind of public service, every kind of service, whether it's transport or communication, the potential for growth is massive. Also, there is potential for leapfrogging. You don't, for instance, have to decimate existing structures in order to build new ones. You go straight into new technologies, as we see happening today in East Africa with fintech and so on. So I think when we focus on opportunities, then we are better placed to look at how to circumvent or how to handle the challenges and there are many ways in which you can innovate to address these challenges. Secondly, I think we should be looking for partnerships. In the past, foreign investors have tended to go it alone, perhaps with support from government and all sorts of, waivers and so on. But first of all, they go into it at a small scale and find the environment difficult to grow because markets are very small. But if you look for partnerships, especially with existing domestic investors that are doing well, you create opportunities for faster growth of your own business. And of course, you have already done some de-risking of the investment itself. I believe that many foreign investors do seem to have an over-exaggerated assessment of the risk in Africa. And I think perhaps working with domestic investors, particularly successful domestic investors, will give you a more, if you like, appropriate assessment of the risk involved, particularly if you're going long-term. Thirdly, as we said, yes, we are looking at integrated Africa, but I think if you look at specific areas, you will see opportunities in different sectors and different subsectors. For instance, we talked about fertilizer. The Dangote Group has recently commissioned a 3 million ton fertilizer plant, which is based on urea and ammonia products. But there are opportunities, for instance, to link up, say, with the investors in Morocco, where they are producing phosphate, or in Namibia, where they have tremendous capacity for phosphate, to link up together and build a more comprehensive fertilizer business, which will indeed not only create the strength and the capacity and the scale to be able not only to supply Africa, but already to supply other regions of the world. We started our fertilizer plant only about 2-3 months ago. We are already exporting to the USA, to Brazil, to Mexico. So there are tremendous opportunities in Africa that, if properly exploited, can generate rapid growth, can promote integration even faster, and can open up the market, not only the African market, but can create new markets for African products and for all investors. So my suggestion is that we should be looking to create structures and platforms that first bring African investors together so that they understand their own relative markets and they can find areas where they can collaborate and cooperate and build scale in respect of their joint businesses and also reduce costs. If we are importing raw sugar today, we produce about 1.4 million tons of sugar in Nigeria today, refined. If we are in a position to work, for instance, with potential partners in Eswatini or in Sudan, where sugarcane is being produced on a massive scale, there will be opportunities to make a really large-scale sugar production capacity that will enable us to export across the world. So I think these are some of the things that we should be looking at if we are coming into Africa. Thank you.
Thank you, Engineer Mansour. Now, lastly, Eva, Engineer Mansour gave 3 key points, but one in particular I thought of was very interesting: partnerships. How does private capital build a partnership with governments in Africa because the regulations are too much. And looking at what the UAE has done, you know, many countries in Africa received independence before the UAE. And look at how they have actually built the country. They had oil wealth, but many African countries do as well. But what is it that you could say African nations need to do? Sorry, I'm putting you in a very strange position, all right? What should they actually do in order to attract that private capital and build those partnerships? And does private capital want to build those partnerships?
Start with the last one. Very easy. Yes, private capital does want to build partnership with public. What can we do as private sector? The answer is very easy. Demonstrate how you're showing value to the government, and they will get out of your way. All right? Don't come there with the intention of, I'm superior to you. Come in with a very humble perception of, I am your partner. This is the point that ails you. This is how I can solve it. Whether it's in building hospitals or schools or roads or creating markets. Every government, like an individual, wants to know they have a partner in you. And less so, I'm private capital, I'm private equity. At the core of what we do is generate returns. But that should not be your leading conversation. Your leading conversation should be, I am a partner to address a problem that ails you. And I do not think there's any government that would be opposed to that narrative or perspective. How can we build that? I think I addressed one of them. It's the PPP frameworks that continue to be rolled out in the continent. The second one is probably leapfrogging some of the traditional sectors, creating skill in traditional sectors. Agriculture comes to mind, at least for my part of the continent. We have very fragmented production capacities, largely retail. If there's a way to institutionalize agriculture, I think it's one value add, because what it means, then you generate in large scale or quantities that can address some of the demand that big companies like the Dangote industries are looking for, all right? So that's the other way that I show mechanization or leapfrogging, as we call it, of traditional sectors. We've seen it with the tech systems, and I think as we roll it out in the banking system, the next frontier would be agriculture and perhaps energy. And that actually brings me to the third point, which is how do we introduce sustainability into development projects? So ESG is already very prominent in private practice. Every private company is implementing sustainable measures, whether it's in energy conservation, environment conservation, or social welfare. So rolling those out in public systems is a place that offers value addition to government, all right? So, and you can do ESG in government in different things. Again, I talk about agriculture. A lot of Africa still relies on rain-fed production. How do we upscale that without necessarily degrading the environment is something our governments are looking for support in from the private sector. And then obviously this being a transport and infrastructure panel, again, how do we institutionalize, formalize, and create value through the transport infrastructure value chain, whether it's from actual development or mechanization of ports, airports, and so forth, is something that a lot of our governments could really benefit from. But ultimately, it just throws back to building on partnerships and coming less so with a profitability mindset and more so with a partner sustainable development agenda.
Ali, can I make a quick
Yes,
addition to this? Because I totally agree with this issue of partnering, particularly public-private partnerships. But I think the lesson in this is that our governments, particularly our public sector people, need to understand and differentiate between partnerships and contracts. Because many of our public agencies and public servants and public sector organizations tend to see every investment arrangement like a contract awarded to the partner. And therefore, there's a perception that the government does have right to take every decision. If it says jump, it expects the partner to just say how high. I think what is required is to recognize that if somebody is putting his money and investing as a partner, he has as much right to the outcomes of that partnership as you, the government, have. And therefore, relationship have to be built on the basis of trust and the basis of an understanding that indeed the parties have equal interest and equal opportunities in terms of the outcomes. I think that's very important. And this has, therefore, implications on our regulatory practices, on our government investment codes, where if you invest, you have that investment is to a large extent largely secured, so long as you have not breached the contract in which you make that investment. Thank you.
Thank you, Engineer. Talking about partnerships, and I'm going to come back to you, Robert and Stephen, before we give the floor to Q&A. Talking about partnerships, where do you see Africa in terms of attracting the $400 billion? And on top of that, added to a certain point that Eva made, was ESG, sustainability. Is it very sustainable to have 2 million trucks on the continent? And how does Africa overcome that aspect? Because this is the next topic, I believe, over the course of the next 5 years that the world is going to be speaking about: sustainability, environment, and where is Africa in this?
Okay, so I'll go first, and then I'll pass it over, if you like, to Robert. And I was going to talk about, on this issue, first of all, on this issue of partnership, to say that the phase 2 and phase 3 of the AFCFTA agreement, the negotiations that are going on now, are actually going to address most of these market-facing functionality questions. So there's going to be a protocol on investments, a protocol on competition policy, a protocol of intellectual property rights, and a protocol on digital trade. And the negotiations for these are quite well advanced. So when it comes to answering the question, what do governments need to do so that you can actually have a facilitation of these partnerships and also the attraction of the money? The AFCFTA agreement is actually going to deal with the harmonization of the regulatory questions that deal with the different competition policies in the different countries, some even bilateral investment treaties within African countries, which of course now are going to become irrelevant once you have an investment protocol for the continent. And then if you are innovating, of course, in one country, even in the question of whatever it is that you're providing, it becomes possible for you to just use only one patenting sort of to operate across the continent. So there is that that harmonization that will first of all make it easy for you, if you go into a partnership with the public sector, to also know that you are playing not only in that market but also in the continental market. Now, but where do we see this 400 billion? So the 400 billion is basically the amount of money that you need to come up with the equipment that you need to operate, first of all, for the trucks, the aviation, and everything. So that's the 400 billion. And today, I would say, if you have a manufacturing, a thriving manufacturing sector, and you want to move agro-foods from Southern Africa to East Africa, and from East Africa to West Africa, there is, of course, a private sector return dimension to these logistics. Most of the transport and logistics businesses are actually run by the private sector. Rarely do we see public sector investing in the kind of trucks that we are talking about. So I think what this money will come from the private sector, and the private sector will put the money there. First of all, if they see there is a business case because there are goods to move, but also because the investment climate through this common investment area that is being created under the phase 2 negotiations is actually going to be to happen. We don't need the public sector money to go into some of these things because it is going to self-generate itself. Again, I said financial services are also going to be liberalized under the current phase of the agreement. So governments are going to make commitments to each other in terms of allowing banks to operate across the continent. And I think this is going to create good competition when it comes to offering loan resources to the operators who want to build these tracks or to operate these tracks. So that's what I would say for that. So maybe
Thank you.
Robert want to come in here.
Yeah, perhaps you can speak about the ESG component because I think that is something I'm also personally interested in.
Yeah, thanks. It's a good question. Where is this money coming from? I think it's going to be public and private, internal and external. If you look at, and it's going to be bilateral as well as multilateral cooperation in Africa. Africa has all kinds of partnerships with countries and organizations and regions around the world. Take, for instance, the Belt and Road Initiative. The Chinese have signed MOUs with several African countries and institutions, and that's why ECA has actually worked with the African Union to develop a continental partnership strategy. And what we're saying here is if we're going to engage, for instance, with China on the Belt and Road Initiative, then we need to make sure that the building block of that partnership should be actually Africa's regional infrastructure project, because the principle here is win-win collaboration. And so if you're going to build continental infrastructure that will facilitate trade with China, that infrastructure should also take into consideration facilitation of trade within Africa. Africa has strong partnership with the EU, for instance, and it leads me to the whole issue of blended finance. I think Europe, one of the priorities of this partnership is about guarantee funds and also blended finance, bringing in funds from European governments plus European investment funds. So we have to tap into that. We also
And a lot of these funds are also looking at that ESG component. Sorry, I'm harping on this because I do believe it's very critical to the sustainability of where Africa is over the course of the next decade or two.
Right. Well, I mean, in terms of sustainable development funds, I think this is something that ECA is also looking at. We're looking at on two dimensions here. One is impact finance, and I think Isaac who mentioned it, the whole concept of developmental corridors that we see in South Africa. It's not just corridors for international trade. How does that benefit also the local communities? And if you look at one of the criteria that we use to select projects for the Program for Infrastructure Development in Africa is the rural-urban nexus and how they link to regional corridors. How do local communities benefit from regional projects? That is one criteria, but this also leads me to the link to green funds. One of the criteria for selecting projects in Africa is how environmental friendly these projects are. How much do they contribute in terms of emissions? And I think that the projects in Africa, based on that criteria, actually qualify to tap from green funds, such as the Global Green Fund. And this also leads me to the Paris, or the last COP in Glasgow, where there was a pledge of 10 billion, 100 billion or so, Stephen, a year. And I think that our infrastructure projects qualify to tap into this fund. Of course, that is not sufficient, but that can contribute in the context of blended finance, but also perhaps in project preparation. One of the biggest challenge that development finance institutions will tell you, they say the money is there, but they don't have bankable projects. And I think that some of these partnerships could also contribute in building the bankability of projects. So I think that's what, if I understand what you are hammering on.
To a certain degree, but I think, let me stop hammering away. I do want to ask the audience over here if they have any questions related to the transport investment infrastructure or even the sustainability of these, transportation infrastructures on the continent. Yes?
Hello? Okay. Hi, I'm Alex Owen Hunt. I'm from FDI Intelligence. We're the foreign investment monitor of the Financial Times. Thank you for a fantastic panel, and we've covered a lot of the topics I already had questions about. But one I would like to ask, I think the COVID-19 pandemic, as well as now the ongoing conflict in Eastern Europe, has shown how dependent a lot of countries are on certain supply routes and certain producers. I wonder, particularly given the discussion about fertilizer, Russia is a massive producer of fertilizer, for instance. Are there huge opportunities now for Africa, given the dependence that companies and countries have on certain supply routes? And maybe potentially these supply routes are now cut off because of sanctions, etc.
I think, Robert, you can end up speaking on this. Yeah.
Okay, no, thank you very much, Alex, for that question. So obviously, in fact, we have been looking at this. Close to 40 African countries are being impacted by this Russia-Ukraine war. When it comes to fertilizers, when it comes to wheat, when it comes to sunflower oil, and all those, including energy. So this creates, of course, opportunities for Africa to deal with this issue of supply chains. I think for a long time we have accepted that global supply chains are efficient. It's becoming critical to show that regional supply chains are very critical to livelihoods and to lives. And so what we've been, just to talk, because we are talking of the AFCFTA, the AFCFTA makes it possible for us to aggregate the fertilizer demands in different African countries, the wheat demand in the different African countries, create an order book that can allow us to negotiate a good price with the Dangotes, because the AFCFTA is already dealing with the internal rules. So countries don't have to worry about the question of different tariffs or customs duties. So we see this crisis helping us to leapfrog the ability to optimize on the opportunities for agro-foods, fertilizer production, and of course energy sourcing within the continent. So ECA is together with the Afrexim Bank and the AFCFTA Secretariat, we are working on something we call the Africa Trade Exchange, which is going to allow for B2B and B2G when it comes to, that will allow for pool procurement. And I think we'll be able to deal with some of these, including food security issues that have actually been exposed so much by the Ukraine crisis, even before we got out of the crisis from the pandemic. Thank you.
Thank you. I think my name is Kabir Foloransho. I work with Nigerian Export Processing Zones Authority, NEBZA, and I think my question goes to Stephen. Based on the plan, the transportation plan for the African Continental Free Trade Agreement, and vis-a-vis the transactional cost of this transportation, especially taking, for example, like in Nigeria, the cost of transporting rice and even the production of the rice from Thailand to Nigeria is cheaper than the one they produce in Nigeria. And the trade corridor, actually, things will be moved from one country to another. How do you think this plan will reduce the transactional cost of investor in African country, vis-a-vis the position of African Continental Free Trade Agreement to even places like economic zones currently, and they need a reduction in the cost of production, but the position of African Continental Free Trade Agreement is not really currently agreeing with it. So thank you.
Thank you very much. Actually, I would have given that question to Robert. He works on transport and logistics, and the trade facilitation dimension. Do you want to take it?
Well, I mean, obviously there's a direct link between the quality of road infrastructure and cost, and that affects the competitiveness of product. I think the biggest problem in Africa, why you find out that maybe to transport a good from Nigeria to Burkina Faso may be more costly than from Japan to Nigeria. And I'm just talking off the cuff. It's because of the quality of the road infrastructure. Because if the quality of the infrastructure is poor, it means that the operating cost of the vehicle is higher, and the charges, extra charges, are passed down to the importers. And so if we improve our road infrastructure, and by the way, that's why we have the Intergovernmental Agreement on the Trans-African Highways that sets standards for our roads. And if we make sure that all our roads meet the standards that have been approved by the African Union, then we do believe that African products will become more and more competitive. And the same applies to the vehicles. If you, 80% or even 90% of the vehicles in Africa are used vehicles. And so the initial cost may be cheaper, but in the long run, if you bring into consideration the maintenance cost, is much more higher, and this passed down also to the cost of products. I think our study has shown that more than 50% of the total cost of products in some landlocked countries is actually attributed to the cost of transport. That should not be more than 5 or 10%. So if we increase or improve the quality of our infrastructure, we improve the quality of our vehicles, the cost of transport as a percentage of the total cost of a product will certainly significantly reduce, and we will not have the experience of transporting a good between Nigeria and Cameroon higher than between London and Lagos. Thank you.
Sorry, I still have to I actually don't believe the only problem is the quality of the road. There are some states in Nigeria that you pay access to the road, and there's some local government that you have to pass through, that you have to pay some people things. All these things add up. Another thing is, again, that I think another thing we need to look at is the value of our currency to do affect it. And no matter how we plan this African Continental Free Trade Agreement, if the costs of the final product is not cheap enough, based on our capacity, the buying capacity, we're still going to buy things from China and other places. I just believe, apart from the quality of the road and what you just said, we should look deeper than that, especially from the main area. Thank you.
Well, you're right. I probably was looking at it from a transport perspective. And even from the transport perspective, it's not just from the quality of the road. We have both physical, which is the quality of the road, and non-physical barriers. These are issues related to regulations. These are issues related to cartels, where transportation of goods is not necessarily reflects the fair price because there's more or less no competition. So if you have very strong cartels in some regions, then you'll find out that the transport cost is very high. I think you also have, in some cases, a lot of checkpoints where you have legal and illegal collection of money. In the past, that used to be very strong, but I think that is reducing. But you are right, there are a whole lot of factors, but I was limiting myself to those related to transport, which I think I've clarified now, are both physical, and that's why I was talking about the infrastructure, but also non-physical, and I think that's what Stephen was alluding to in terms of trade facilitation, which relates to regulations, numerous checkpoints, you have constraints at the border post, where you have checks. In fact, this is being resolved now by having joint border posts between countries, where you don't have checks in country A
Do we have any other questions from the audience? If not, then questions from or any statements that you want to leave, panelists? No? Okay.
So just to say that the agreement, it has an annex on trade facilitation on how to deal, especially with this bad part of the non-tariff measures, the non-tariff barriers. And there is already a reporting mechanism. So if you're operating a truck from Abidjan to Lagos and you encounter non-tariff barriers that you are not, that are adding to your costs, there is now an online platform to report that. And so when the state parties meet in their committee settings of the AFCFTA, then countries that where those NTBs are happening will have to explain and to give a timeline on when to remove them. And this is a best practice already that is happening in East African community, in COMESA, probably in SADC, and now it's going to become Continental. So I think I wanted to add that, and hopefully we'll be able to see a reduction in the cost of moving goods across the continent. Thank you.
On that note, I actually want to say thank you to the panelists and the presenters. Thank you to the AIM, the Annual Investment Meeting, the Organizing Committee, and the Ministry of Economy for allowing us to be over here, and to all of you for being present with us. Thank you.